I have lived long enough to watch investors fall in love with a phrase, mistake a slogan for an asset, and then discover that what looked like progress was really just capital moving in a circle until confidence finally ran out. That is why when I hear people arguing over whether artificial intelligence is a bubble, I do not start with the excitement. I start with the plumbing. I do not care how dazzling the demo is if the financing underneath it has begun to behave in a way that turns revenue into theater, turns leverage into destiny, and turns every fresh dollar into a sacrifice demanded by the last dollar already committed. That is what caught my attention here. A lot of people want this discussion to be ideological. They want it to be a fight between optimists and pessimists, between believers and doubters, between those who think artificial intelligence will save the economy and those who think it will destroy jobs, truth, and human agency. I have never found those debates especially useful when money is involved. I prefer to ask a much simpler question: where does the cash go, who is locked in, and what has to be true tomorrow for the promises made today to remain believable? If you ask that question long enough, the picture gets less glamorous and much more important. Artificial intelligence is real. It is already changing products, workflows, search, software, customer service, code generation, creative work, and data analysis. It may transform many industries. It may create extraordinary companies. It may raise productivity in ways that are hard to see clearly at the beginning. I do not have any trouble believing that. What I do have trouble believing is that every dollar now pouring into the system is being allocated with discipline, priced with honesty, and matched to an economic reality sturdy enough to justify the build-out now taking place. I have seen enough cycles to know the difference between a promising technology and a dangerous capital structure built around a promising technology. Those are not the same thing. Railroads changed America. That did not stop railroad speculation from ruining people. The internet changed advertising and communication. That did not stop the late 90s from producing absurd pricing, heroic assumptions, and a graveyard of businesses that disappeared long before the technology fulfilled its promise. Housing was essential. That did not stop leverage, circular confidence, and lazy underwriting from turning it into a national catastrophe. So when I look at artificial intelligence, I do not begin with whether the tool is useful. I begin with whether the financial machine surrounding the tool has started to manufacture demand, hide risk, and socialize the eventual pain. That is where the story becomes serious. Most people see the visible names first. They see OpenAI, Anthropic, Zai, Claude, Grok, ChatGPT, Nvidia, AMD, Oracle, and the giant cloud providers. They see stunning valuations, eye-popping commitments, and headlines about hundreds of billions of dollars. They see data centers rising out of the ground, chip orders climbing, partnerships multiplying, governments mobilizing, and stock prices responding like a crowd, hearing exactly what it wants to hear. The public interpretation is simple. Demand is exploding. The future is arriving. The winners are building the infrastructure of the next industrial age. There is some truth in that. There is also something more troubling. A meaningful portion of this system appears to work because one participant funds another participant on the condition that the money circles back into the ecosystem, records as revenue, boosts confidence, and supports the next financing round or the next capital commitment. When that starts happening in size, you no longer have simple demand. You have a loop. And loops are dangerous because every participant can point to a real transaction while the system as a whole drifts farther away from independent price discovery. I want to make that plain. If a chip supplier invests enormous sums in an artificial intelligence lab, and that lab then uses that strength to buy chips from the supplier, the transaction may be legal, disclosed, and celebrated. But economically, you should ask what really happened. Did independent demand appear, or did capital get routed through an investment agreement so that the seller could book revenue, the buyer could keep scaling, and the market could interpret the whole event as proof of unstoppable appetite. That distinction matters because if the appetite is genuine, a business can slow down, cut prices, endure a recession, and still find customers who want the product badly enough to pay for it. If the appetite is partly manufactured inside a closed circle of financing, then the moment one participant loses flexibility, the whole picture changes. I saw that danger in the way certain housing assets were financed years ago. I saw it in structures that looked diversified but were really dependent on the same fragile assumptions. I saw it in cases where rising prices seemed to validate the model, when in truth rising prices were the model. That is the kind of thing that deserves your suspicion. Take the excitement around the current artificial intelligence leaders. The narrative says the labs need enormous compute power. That is true. The chip makers produce the scarce instruments. That is also true. The cloud and data center operators buy the hardware, build the capacity, and rent the compute. That part is true as well. The danger begins when each link in that chain starts financing the next, reinforcing valuation at every step, and using headline numbers to convince the market that demand is both vast and durable before the underlying economics have had time to prove themselves. If Nvidia invests in OpenAI and OpenAI uses that ecosystem to purchase huge quantities of Nvidia product, the public sees growth. If Oracle signs an enormous data center commitment tied to OpenAI and then uses that infrastructure spending to buy more Nvidia chips, the public sees another signal of growth. If a provider such as CoreWeave buys large quantities of chips, receives special downside support, then goes public with major backing that strengthens confidence, the public sees yet another signal of growth. If AMD structures arrangements that link customer relationships, equity participation, and stock appreciation, the public sees a competitive race validating the whole field. If Microsoft, Amazon, and Google all invest in labs and lock those labs into their own infrastructure, the public sees a war for the future. The market loves this. It sees velocity, it sees urgency, it sees trillion-dollar ambition. What I see is a dependency web. Each party becomes someone else's justification. Each announcement becomes another piece of evidence used to support the valuations already granted. Each loop creates more pressure to keep the loop alive. That is where capital stops behaving like capital and starts behaving like oxygen in a closed room. It has to keep circulating because the system is built to panic if it does. A healthy capitalist system can survive disappointment. An unhealthy one needs fresh enthusiasm every quarter. Artificial intelligence today increasingly looks like a machine that requires continuing escalation just to protect the assumptions already embedded in the last round of spending. That is not the same as saying the technology is fake. It is saying the capital structure around the technology may be demanding a kind of perfection that business history rarely provides. People often miss this because revenue gets recorded cleanly. A chip sale is a chip sale. A cloud commitment is a cloud commitment. A data center order is a data center order. The accounting may not lie in a narrow technical sense, but incentives can still distort what outsiders think the numbers mean. If I lend you the money, or take an equity position that supports your balance sheet, or commit to your offering in a way that stabilizes market confidence, and you then use that strength to buy my product or reinforce the valuation of the ecosystem we both depend on. Outsiders may see independent growth where what they are really seeing is a strategically self-reinforcing structure. That is why economists start using phrases like round tripping. That phrase should make you uncomfortable. It made me uncomfortable the first time I heard it in older scandals, and it makes me uncomfortable now. Round tripping is one of those polite financial expressions that often hides a simpler truth. Money moved, paperwork cleared, people celebrated, and yet very little genuine economic distance was traveled. The market may treat these transactions as evidence that future demand is robust and that present pricing is justified. But if too much of the demand is being sustained by participants whose own valuations depend on keeping the ecosystem looking unstoppable, then you are no longer dealing with a straightforward industrial expansion. You are dealing with a reflexive system. The higher the stock price goes, the easier it becomes to do deals. The easier it becomes to do deals, the more revenue appears, the stronger the stock price becomes. That is a marvelous arrangement until something interrupts it. When I study systems like this, I always ask what happens if growth slows just enough to force each participant to think about its own survival rather than the ecosystem's momentum. That is where the difference between a great technology wave and a dangerous financial wave becomes visible, because the loop does not end with the famous companies. It expands outward. That is where the story becomes even more significant. Behind the glamour of the labs, the chips, and the software sits a second layer of actors that the average investor barely notices. Wall Street, private equity, private credit, real estate developers, utilities, land buyers, infrastructure financiers. These are the people buying the dirt, the buildings, the debt, the power rights, and the long-term contractual claims that make the artificial intelligence boom physically possible. Once you notice them, you begin to understand why the scale of this bet matters so much. This is no longer just about software. It is about physical infrastructure on a massive scale. Data centers are not abstractions. They are warehouses full of expensive hardware, enormous cooling systems, backup equipment, security layers, heavy electricity demand, water consumption, and financing obligations. They sit on land. They need roads, grid connections, approvals, and neighbors willing to live beside them. They are costly to build, costly to upgrade, and costly to keep relevant if hardware cycles move faster than depreciation schedules. That last point matters more than most people realize. Technology can become obsolete much faster than the financing model expects. If the useful life of equipment in the real world is shorter than the useful life assumed on the books, then a system can report healthy profits while silently building fragility. I have seen that movie before too. Private equity has rushed into data centers because it sees a perfect arrangement. Build or acquire the shell, lease it to a giant technology customer, collect rent, keep the tenant's strategic ambitions off the tenant's balance sheet as much as possible. Use debt intelligently, at least in theory, participate in one of the biggest spending booms of the era without having to invent the software, design the chip, or win the consumer. On paper, it looks elegant. In practice, it multiplies risk. If demand stays ferocious and pricing holds, private equity looks brilliant. If utilization slips, if chip rental prices compress, if the labs fail to monetize their products at the scale promised, or if the hyperscalers realize they have overbuilt, then those beautiful shells become very expensive containers for disappointment. I want you to picture what that means. A giant server facility is not a handbag. It is not a famous brand with resale appeal. It is not an apartment building in a dense city where human need provides a natural floor. It is a highly specialized asset built for a particular wave of demand, funded with expectations that are often more rigid than the market itself. Once you pour the capital into a server farm, who exactly do you sell it to if the wave cools? That question should haunt every lender and every equity partner involved. And yet the spending continues because no one wants to be the party that blinked before the race was won. That is the hallmark of a modern arms race. Individual caution becomes institutionally difficult. No one wants to underbuild if artificial intelligence really does transform the economy. No one wants to tell the market that returns may take longer, that margins may disappoint, that utilization may lag, or that some headline commitments are less economically solid than they appear, and so money keeps moving. Land is bought. Farmland and suburban industrial sites are transformed. Communities that once worried about ordinary development are asked to absorb facilities so large They redefine the physical and political landscape around them. The sales pitch is predictable: jobs, growth, innovation, national competitiveness, a place in the future. I have heard versions of that pitch in many industries. Sometimes it is partly true, sometimes it is mostly an excuse used to make the local public bear costs that do not show up in investor presentations. That is one of the ugliest habits in finance. Privatize the upside story. Diffuse the downside burden. In this case, the burdens are not theoretical. They include land use, they include noise, they include water, they include power, they include pollution, they include pressure on local infrastructure, they include higher utility costs for ordinary households who never asked to finance a technological arms race with their monthly bills. A lot of people still imagine the artificial intelligence boom as something happening in cloud diagrams and conference rooms. It is happening there, but it is also happening in counties, on roads, on power lines, and inside utility rate cases. When a project needs extraordinary energy, that energy must come from somewhere. When enough projects arrive at once, the grid strains. When the grid strains, upgrades are needed. When upgrades are needed, somebody pays. The companies involved often do not want to pay the full incremental cost. That is where lobbying enters. If utility law and regulatory design allow the cost to be spread across the public, then the family living paycheck to paycheck becomes an involuntary participant in the financing of a system from which it may receive only vague future benefits and immediate higher bills. That is not a small matter. It is not abstract. A $10 or $20 increase on a monthly bill means very little to the people structuring a $100 billion ecosystem. It means something very different to millions of households. That is how financial empires are often built. Not only with dramatic investments, but with subtle transfers that look minor at the individual level and enormous in aggregate. Then there is the environmental arithmetic. The need for power is so great that workarounds emerge quickly. If the grid cannot deliver on the schedule desired, on-site gas solutions appear. Environmental reviews are rushed or softened where possible. Communities already living with pollution become convenient hosts, because political resistance is easier to manage there than in wealthier areas with stronger legal resources and more public attention. This is another old lesson. When money moves fast, inconvenience usually lands on those with the least power to refuse it. The story also becomes less attractive when you ask how many long-term jobs all this construction creates. A burst of activity that is real. But once a data center is built, the permanent employment can be remarkably limited relative to the scale of the capital involved. That matters because society is being told, implicitly and sometimes explicitly, that this boom justifies broad public accommodation. If the jobs do not scale with the burden, if the tax benefits are uneven, if the utility costs rise, if the environmental stress grows, then local communities are not really participating in the upside. They are hosting it. That is a very different arrangement. I am always suspicious when a gigantic investment wave is sold simultaneously as a private opportunity and a public necessity. It usually means the people closest to the deal want the private returns, but also need public cooperation, public subsidy, public patience, or public silence. The next sign of fragility comes from price behavior in the market for rented compute and chips. In any real boom, there will be periods when demand races ahead of supply and pricing becomes strong. That is normal. But when pricing starts to soften before the long-term thesis has had time to fully prove itself, that tells you something. It tells you that supply may be arriving faster than demand capable of paying rational economics for that supply. And once that happens, the story changes. All the heroic plans still exist. The buildings still stand. The debt still accrues. The equipment still depreciates. But the revenue assumptions become less sturdy. That is how overbuilding begins to reveal itself. Not all at once. Not with a great trumpet announcing the mistake. Usually with little price moves. softer utilization, awkward contract terms, and increasingly creative efforts to preserve the appearance of strength. That is why I do not like calling the situation merely a bubble. A bubble, at least, carries the comforting implication that there is an eventual pop, a violent recognition, a reset, and then a chance for capital to be reallocated with greater honesty. What I see here is more dangerous. I see something closer to a black hole. Capital goes in and the exit becomes uncertain. The commitments are so large, the physical assets so specific, the financing so dependent on continuation, and the political stakes so broad that the system is incentivized to keep consuming resources long after the economic return has become less clear than the headlines suggest. A bubble can burst, a black hole absorbs. That is the distinction. Let me explain why I think that difference matters so much. There is no easy exit. If you buy a stock at a foolish price, at least in theory you can sell it. If you build a gigantic data center financed with debt, specialized to the needs of a fast-moving technological wave, your exit choices are far narrower. You need utilization, you need tenants, you need hardware that remains valuable, you need power economics that do not collapse the margin. You need a next user if the first user disappoints. That is a very demanding chain of requirements, and because so much of the build-out is financed, slowdown is not neutral. Slowdown is dangerous. A highly leveraged system cannot simply pause and think. It must service debt. It must justify carrying values. It must preserve confidence. It must keep feeding the machine because yesterday's promises are secured by tomorrow's expansion. That is not ordinary capitalism. That is treadmill capitalism. The second reason it behaves like a black hole is that truth arrives slowly. Many of these assets do not trade frequently. Private equity marks do not update with the brutal honesty of a public exchange. Every second of the day, private credit does not scream its pain immediately the way an ordinary bond market can. Specialized infrastructure can remain on books at values that feel plausible long after market appetite has shifted. Depreciation schedules can flatter the present. Useful life assumptions can flatter the present. Adjusted metrics can flatter the present. By the time the accounting catches up, enormous sums may already be trapped. That is exactly the type of environment where intelligent people can persuade themselves that conditions remain healthy because visible prices have not yet forced confession. The absence of a daily market verdict is not the absence of risk. Sometimes it is the exact condition that allows risk to compound in silence. That is what made prior episodes so destructive. The bad assets did not wake up one day and confess. They had to be dragged into daylight. By then, the capital structure around them had already become fragile. I pay close attention whenever large corporations start adjusting the assumed life of major equipment in ways that flatter earnings. Maybe the assets truly last longer, maybe the engineering supports it. But if the economic usefulness of the equipment is shorter than the accounting usefulness, then reported profits begin to tell a story that reality may not honor. When an investor like Michael Burry starts warning about that kind of thing, I listen. Not because any one person is infallible, but because history teaches you to pay attention whenever accounting assumptions and technological obsolescence begin drifting apart. If the real world moves on in 2 or 3 years, and the books still pretend the hardware is happily generating value over 6, the reported profits may be healthier than the economics. That gap eventually matters. The third reason this behaves like a black hole is that there may be no obvious alarm bell. People keep waiting for a grand collapse, a theatrical moment, something with the sudden violence of Lehman Brothers. I am not sure that is how this ends. If it ends badly, a system like this can deteriorate by inches, construction delays, projects paused quietly, utilization lower than expected, rentals softening, startups closing without spectacle, infrastructure spending deferred, private credit stress emerging in places ordinary investors do not monitor. None of those events individually need look decisive. Together they can drain the system. That is the most treacherous kind of failure because public confidence can remain oddly high while the economics quietly worsen underneath. As long as the headlines keep coming, as long as another large deal is announced, as long as executives keep speaking the language of inevitability, the market can remain supportive. And why would it not? The dream is immense. Who wants to admit caution in front of a story? This grand replace human labor. Transform every industry. Rewrite software. Control the next strategic layer of the global economy. The incentives to keep believing are enormous. That is why I think the danger is not simply valuation excess. The danger is strategic entrapment. Once enough powerful institutions commit to a narrative, this large few of them can afford to be seen stepping back. That now includes government. When a national government begins openly treating artificial intelligence as a strategic race, akin to a modern Cold War competition, the economics become even harder to separate from politics. Once that happens, ordinary market discipline weakens. Projects that might have been judged with simple financial caution start receiving the moral force of national necessity. That changes behavior. Investors become more tolerant. Executives become more ambitious. Lenders become more accommodating. Public scrutiny becomes easier to dismiss as backward, fearful, or unpatriotic. I never like it when a business case becomes too entangled with historical destiny. It clouds judgment. The latest federal push toward artificial general intelligence makes this even more important. When the full weight of government joins big technology and Wall Street, the machine gains legitimacy, urgency, and political insulation. That does not guarantee success. It guarantees scale. Scale is not the same thing as wisdom. Sometimes scale is simply the amount of damage a mistaken assumption can do before anyone dares to challenge it. Now, I want to be fair. There is a best-case scenario here. I can see it. The technology matures, the strongest companies survive, the absurdities get washed out, the infrastructure built today becomes the foundation for real productivity tomorrow. Workers use these tools to become more effective. Smaller businesses gain capabilities once reserved for very large institutions. Medical research improves, software gets easier to create and maintain. Routine tasks are automated. The economy absorbs the transition better than critics expect. It has happened before that a period of speculative excess built something that later became genuinely useful. That is not impossible. But even in that good scenario, the costs of the build-out, the distortions of the financing, and the uneven distribution of gains would still matter. A good ending for the technology does not erase the importance of asking whether the capital allocation on the way there was sound. Then there is a much darker possibility, not the science fiction fantasy people like to discuss at dinner, but a more ordinary and historically recognizable danger. The merger of capital, infrastructure, data, and state power into a system of control that expands in the name of security, efficiency, or national competition. I do not claim certainty there, but I have lived through enough government expansions, justified by fear, to know that once a society hands extraordinary technical capability to institutions already rich in money and access, the future depends as much on incentive and restraint as it does on innovation. That deserves sober attention. Still, the most likely path is not utopia or instant dystopia. It is the messier middle, a system that keeps advancing technologically while remaining financially distorted. A system that produces genuine winners but also traps huge sums in overbuilt infrastructure and overhyped expectations. A system that may never give the public a clean moment of recognition because the losses can be smeared over time through depreciation, refinancing, rate structures, private marks, and quiet restructurings. That is why I return to the phrase black hole. Money goes in, power goes in, land goes in, debt goes in, public patience goes in, political backing goes in, and unless the final economics become extraordinary, a great deal may never come back out in the form the public imagined. Some of it will disappear into obsolete equipment, some into lower than expected utilization, some into debt service, some into utility bills borne by others, some into the gap between reported value and realizable value, some into projects that looked strategic but were really just momentum wearing a patriotic costume. What makes all this especially seductive is that the market can reward the behavior for a long time. Stock prices go up, executives look visionary, financial sponsors look brilliant, early employees become wealthy, announcements receive applause. Skeptics are mocked as people who do not understand progress. I have seen that movie too. The crowd is never more impatient with discipline than when a new era appears to be starting. But discipline matters most in new eras. It is easy to look wise after a disaster. The hard thing is to remain rational during a boom when every incentive points toward surrendering your standards. My own approach has always been embarrassingly simple. I like useful products. I like understandable economics. I like honest accounting. I like businesses with room to make mistakes without blowing themselves up. I like customers who pay because they need the service, not because the ecosystem financing has not yet forced a reckoning. I like assets that can be repriced and reallocated with some degree of realism. And I never like systems that need constant expansion merely to preserve the appearance that prior expansion was sensible. Artificial intelligence may produce magnificent businesses. Some of the companies involved will likely become stronger than they are now. Some of the spending will prove justified. Some of the infrastructure will be fully utilized and even look cheap in hindsight. But that is not the same as saying the overall structure is healthy. A few great outcomes can coexist with widespread capital destruction. That is another lesson people forget. The best survivors of the dot-com era became extraordinary businesses. That did not save everyone who financed the mania carelessly. You do not need to reject the technology to reject the structure. You do not need to hate innovation to distrust circular financing. You do not need to predict the end of artificial intelligence to see that Wall Street and big technology have built an apparatus that now depends on public faith, accounting discretion, physical build-out, and continuing access to cheap narrative capital. Narrative capital may be the most dangerous kind because it feels free until the day it vanishes. Then everyone discovers how expensive it really was. There is another piece of this that matters to ordinary people. Even if you never buy a single artificial intelligence stock, you can still pay for the boom. You can pay for it through your utility bill, through public infrastructure strain, through local land transformation, through tax incentives, through retirement funds exposed to private equity vehicles that own the physical backbone of the trade, through credit markets absorbing losses that eventually tighten conditions for unrelated borrowers, through a job market altered by tools adopted on a timetable set by financiers rather than communities. That is why ignorance is dangerous. Not because everyone must become a chip analyst, not because everyone needs a grand theory of machine intelligence, but because whenever money and power arrange themselves around a story this large, the people who do not understand the structure are the ones most likely to pay for it without ever being invited to the table. I do not say that to frighten you. I say it because the antidote has always been the same. Learn how incentives work. Learn who funds whom. Learn which revenues are truly independent and which depend on circular support. Learn the difference between a useful product and a self-reinforcing capital machine built around a useful product. Learn where the burdens are being shifted. Learn how accounting can flatter a period. Learn how private markets can delay recognition. Learn how leverage changes the meaning of optimism. Most fortunes are not lost because people fail to identify the next great technology. They are lost because people confuse a great technology with a great. Those are very different judgments. One asks whether the world is changing. The other asks whether the price paid, the financing used, the counterparties involved, the contractual terms signed, and the hidden obligations assumed leave enough margin of safety. Margin of safety is still the idea that matters most. It mattered before computers, it mattered before the internet, it matters now. If artificial intelligence becomes as important as many people believe, there will still be no excuse for financing it foolishly. If it disappoints, the lack of discipline will be even more painful. Either way, the structure matters. I have learned to mistrust any era in which people speak as though a giant strategic race excuses every bad incentive inside it. That is how capital gets swallowed. Not by one dramatic lie, but by 1,000 tolerated shortcuts. Not by one villain, but by a system in which each participant can justify its own behavior by pointing to the urgency created by everyone else. That is what makes this so dangerous. The labs say they need more compute. The chip makers say demand is insatiable. The cloud providers say the future must be built now. Private equity says the infrastructure is essential. Utilities say the grid must adapt. Governments say the nation must lead. Investors say the story is too important to miss. All of those statements can contain some truth. Put together without restraint, they can also become a machine with no reverse gear. That is why I do not think the right question is whether artificial intelligence is a bubble. A bubble is too simple. A bubble suggests a clean shape, a visible distortion, and an eventual burst that clarifies matters. What I see is a deeper problem. A capital system so powerful, so politically reinforced, and so physically expansive that it can continue consuming money, power, land, and public tolerance long after the line between real return and symbolic momentum has become difficult to see. That is the black hole. And once you see it that way, the right response is not hysteria. It is discipline. Do not become the person who dismisses every change because you are uncomfortable. That is foolish. Do not become the person who embraces every deal because progress sounds noble. That is foolish too. Try to understand the machinery. Try to separate the extraordinary possibilities of the technology from the very ordinary weaknesses of human incentives. Try to remember that the most expensive words in markets are often the grandest ones: revolution. Inevitable, transformative, unlimited. Those words may prove true over time. They are still dangerous words to underwrite blindly. I have made my share of mistakes, but the costliest ones always began when people around me started acting as if scale itself were proof, as if velocity itself were validation, and as if anyone asking where the cash ultimately came from simply did not understand the future. The future never frightened me. What frightened me was always the same thing. A crowd convinced that because the destination sounded magnificent, the bridge did not need to be examined. That crowd is alive and well today. So look carefully, watch the loops, watch the accounting, watch the land purchases, watch the power strain, watch the debt, watch the way private assets are valued, watch the way public burdens get normalized. Watch what happens when utilization stops keeping pace with ambition. Watch what happens when hardware ages faster than spreadsheets. Watch what happens when the people promising abundance also need constant new financing to prevent yesterday's assumptions from breaking. You do not need to predict exactly how the story ends to protect yourself. You simply need to recognize that this system may not release capital gracefully. That is enough to change your posture. A rational investor does not need omniscience. He needs an appreciation for incentive, fragility, and the price being paid for uncertainty. That remains true whether the subject is railroads, housing, software, or the most talked about technology of our age. Artificial intelligence may change the world. I would not bet against human ingenuity, but I would be very careful about betting that every dollar now being swallowed in its name will come back with the return people have penciled into their models. That is not skepticism about invention, that is respect for arithmetic. And arithmetic, in the end, usually wins.